Midnight in Brussels. The U.S. envoy slams his fist and demands NATO sanction China. Across the ocean, Beijing warns Mexico impose those 50% tariffs and your economy pays the price. German auto workers whisper about layoffs. Mexican dealers lock their showrooms. In Iowa, silos overflow with unsold soybeans as futures crash in the steepest drop since 2012. Meanwhile, Brazil cashes in. New factories, new trade deals, a new hub for China's rise. And the question explodes, has America cornered China or just triggered its own collapse? Inside the room, European leaders stare down the numbers. The EU runs a trade deficit with China exceeding 300 billion euros. German assembly lines rely on Chinese battery cells. French supermarkets depend on cheap Chinese consumer goods. If tariffs slam into place, it isn't Beijing that feels the first blow. It's Europe. The American side makes its case in blunt terms. Without full alignment, NATO is financing Russia's war. Officials warn that countries still buying Russian oil, Hungary, Slovakia, Turkey, are undercutting sanctions. The fix, they say, is to cut off China, the partner enabling Moscow's energy lifeline. From Washington's perspective, the logic is clean. For Europeans, it looks like economic suicide. Factories in Wolfsburg whisper about layoffs. One engineer tells colleagues that if Chinese batteries are blocked, we can't ship a single electric model by year's end. In Paris, retail chains warn of 15% price hikes if Chinese textiles and electronics vanish from shelves. The political fallout would be brutal. Inflation already toppled governments before. Could leaders risk repeating that? Beijing reacts with fury. A foreign ministry spokesman warns that NATO is internationalizing coercion, while state outlets broadcast images of container ships rerouted to South America. In the first half of this year alone, Chinese crushers booked over 7 million tons of Brazilian soybeans while orders for U.S. beans collapsed. The boycott is near total. For decades, American farms fed China. Today, silos in Iowa stand heavy with grain nobody ordered. The USDA estimates U.S. soybean exports to China once topped $34 billion annually. Now, Brazilian contracts swallow the market. Farmers who once relied on seasonal shipments watch as rail cars sit idle. One grower in Illinois admits, "I'm staring at bins full of soy I can't move. Brazil already sold my crop." Futures markets feel the weight. In a single week, soybean prices saw their steepest drop since 2012. But this isn't just economics, it's leverage. Food was America's silent weapon, a resource China couldn't ignore. By cutting U.S. crops from its diet, Beijing is erasing one of Washington's last pressure points. And with Brazil expanding port capacity in Peru and Argentina, the diversion is permanent. Mexico steps into the crossfire. Pressured by Washington, it imposes tariffs of 50% on Chinese cars, steel, and textiles. The blow is seismic. Mexico is China's largest car market in the Americas, with over 280,000 vehicles sold in just 6 months. A dealer in Mexico City slams his showroom doors, muttering that even at half price, my customers can't afford these anymore. Beijing's response is immediate. Officials warn Mexico to think carefully, hinting that retaliation could target Mexican avocados and pork exports. For farmers in Michoacán, the risk is existential. China buys what domestic markets can't absorb. Lose that outlet, and an entire region collapses. At the same time, Brazil seizes opportunity. BYD celebrates the rollout of its first electric vehicles from new plants in Sao Paulo. Weeks later, Great Wall Motors announces a second factory for pickup trucks. Chery partners with Brazilian firms to expand assembly lines. Each announcement lands separately, each a nail in the coffin of Mexico's role as China's Latin American hub. The pattern sharpens. When Washington builds a wall, Beijing builds a bridge. Rare earths flow from Africa under new long-term contracts. Grain from Brazil replaces Iowa shipments. Electric vehicles emerge from Brazilian plants instead of Mexican ports. Supply chains rewire themselves in months, not years. Let's stop, because this wasn't supposed to happen yet. Tariffs were meant to isolate China. Instead, they accelerate China's exit from American dependence. What if the strategy designed to corner Beijing is cornering Washington instead? That reset question jolts NATO leaders. In Berlin, policymakers quietly calculate that EU inflation could jump by 8 to 15% if Washington's plan is followed. Italy warns of textile shortages. France fears mass protests. German auto chiefs tell their government flatly, layoffs are inevitable. If NATO fractures over tariffs, Moscow celebrates and Beijing gains. Meanwhile, Washington insists the pressure must expand. Officials highlight India's rising intake of Russian crude. 40% of its oil now flows from Moscow, compared to barely 1% before the war. If China and India both finance Russian energy, then NATO's sanctions are porous. The US argues that allies must choose between strategic integrity and economic comfort. Markets convulse. Chicago pits record the largest single-day soy sell-off in a decade. European steel prices surge on fears of supply cuts. Mexican automakers warn consumers to expect vehicles 20% more expensive than before, even after tariffs. Investors call it a policy whiplash that drains confidence. China answers with its own weapons. Regulators open investigations into American tech giants, citing anti-monopoly violations. Licenses for U.S. agricultural exporters are suddenly suspended. Beijing hints that it could scale down its treasury holdings if sanctions intensify. Even the suggestion rattles bond traders already nervous about high yields. In Brussels, cracks widen. Finance ministers from southern Europe balk at tariffs, arguing domestic economies just can't absorb the shock. Germany leans against aligning fully with Washington, pointing to its dependence on Chinese supply chains. Behind closed doors, NATO unity strains under pressure. Meanwhile, Mexico's debate turns ferocious. Business chambers warn that aligning with Washington could cost billions in lost Chinese investment. Yet officials cling to U.S. trade privileges under USMCA as lifelines. The calculation is brutal: anger Beijing or risk Washington's wrath. Either path means collateral damage. Brazil smiles. Every diverted supply chain flows into its ports. EVs, soybeans, robotics. Analysts suggest Brazil could become China's gateway for advanced technologies across Latin America, from AI chips to next-generation batteries. Washington tries to isolate Beijing, but Brasilia cashes the dividend. In the middle of the standoff, a quiet announcement slips through financial wires. China's state-owned banks finalize a new clearing system with Brazil, allowing direct settlement in renminbi for both agricultural and industrial trade. The move bypasses the dollar entirely. Traders note that within weeks, over a third of Brazilian soybean contracts are no longer priced in dollars. Analysts in New York call it a tectonic shift, warning that if replicated in energy or technology exports, the dollar's role as the primary trade currency in Latin America could erode at unprecedented speed. At the same moment, Mexico's energy sector becomes the next target. Beijing signals that Chinese companies will halt planned investments in Mexican solar and battery plants, redirecting them to Brazil and Chile. For Mexican workers, that means thousands of potential green energy jobs evaporating overnight. The symbolism is cutting. The very industries Mexico hoped would diversify its economy away from cheap manufacturing now risk being lost to rivals across the region. In Europe, fears stretch beyond inflation. Security agencies warn that alienating China could jeopardize access to critical raw materials. Rare earths, vital for both defense and green technology, remain overwhelmingly concentrated in Chinese supply. Internal EU papers concede that replacing those supplies would take years, during which NATO's technological edge could be blunted. For defense contractors in Germany and France, that scenario isn't theoretical, it's existential. The ripple spreads to Wall Street. Bond traders report sudden jitters as rumors circulate that China could gradually slow purchases of new U.S. treasuries. Even a small pullback raises yields and threatens Washington's ability to finance record deficits. One strategist at JP Morgan puts it plainly. If Beijing reduces exposure by even 5%, we're looking at the steepest borrowing costs in a generation. And as the pressure mounts, a final scene emerges. Farmers in Iowa staring at unsold crops, auto workers in Germany fearing pink slips, Mexican dealers shuttering showrooms. Each crisis looks separate. Together they form a single question. Is Washington's bid to sanction China a strategy of strength, or the spark of a realignment it cannot control? Mexico's tariffs hit $50 billion of trade. Chinese levies erase America's price edge by adding $2 per bushel on U.S. soy. European forecasts project double-digit inflation if they align with Washington. And U.S. farmers, once the world's breadbasket, are looking for at canceled contracts and rotten foods. So the question hangs. Washington demands NATO sanction China, Beijing warns Mexico, and Brazil reaps the gains. But what if the alliance meant to box in China discovers it has boxed in America instead? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.